Welcome to Chit Chat Stocks, a podcast that helps you discover your next great investment. I'm one of your hosts, Ryan Henderson, and I am joined, as always, by the one and only Brett Schaefer. This is our weekly Power Hour episode. We do these every Thursday, usually at 5 p.m. Eastern Time. We're doing this on a Wednesday because I had a recording conflict for tomorrow, but if you're listening to the podcast players, it'll come out at the same time anyways. But if you're interested and want to ask us questions, you can head on over to YouTube, Chit Chat Stocks, and ask us questions as we do these shows live. But we talk all things financial markets on these episodes. We riff because lately there's been a lot to riff about. Brett's got an interesting bubble watch for this week. We've got earnings reports. We've got some stinky earnings reports as well for a couple companies in my portfolio, unfortunately. But we're going to get to all of that: Spotify, Shopify, Monday.com. We've got 100-year bonds and plenty more. And I also have a fun game, Brett, that I'm going to play called Value Play or Value Trap. We're going to go quick fire with a number of cheap looking companies, and I'll get your take. But without further ado, where do we want to start?
Ryan, I guess maybe welcome in everyone. Yeah, you might have problems in your personal life. The government may have a giant conspiracy going that is going to bring down civilization, but don't worry, the Dow is at 50,000. Did you? You may or may not get the reference I'm making there, but I think a lot of listeners do, and I can tell you after if you don't. People are asking here in the chat already about PayPal. We talked about them a bit last week. People asking thoughts on Ackman exiting Nike and Chipotle. Maybe if we have time, we can discuss that. But I think, Ryan, we should begin. People were asking last week about Monday.com. It's a company you bought, and you told me, unfortunately, he said this offline, but it was the quickest 50% drawdown you've ever experienced. I think people would be interested to see, especially because software is just an extremely hot topic right now. We released this morning for people listening on Friday. This was released Wednesday morning. The other podcast in your feed this week with Drew Cohen from Speedwell Research, a comprehensive interview covering Constellation software. And it seems that people really, really wanted to listen to that episode. So I think why not start with Money.com, catching the falling knife. What were your thoughts here, Ryan, on the quarter?
Yeah, I wish I could just point to the SaaS apocalypse or the software Mageddon that's happening right now and say, everyone's wrong. I'm right. Monday.com's earnings weren't that bad. But that is not the case. Monday.com reported earnings on Monday, as they do every quarter. It'd be a lot cooler if they beat earnings and did it on every Monday, but to
What,
wake up,
what, what do you think about that as the branding? Do they do it Monday morning?
yes. And it's
Okay, that's not bad branding. I like it. I like it.
Yeah, I mean, that'd be great if I didn't have to wake up to a company down 20% on my Monday morning. But yeah, spoiler alert, bad report. The I told Brett this is the quickest stock I've ever owned to drop 50%. It's not a huge chunk of my portfolio, but it has dropped. It's been cut. The first shares I purchased were cut in half, and so far I've made the mistake of doubling down. But they reported earnings on Monday. Revenue was up 25%. Operating margins contracted. So this was basically the concern for me. And they've kind of been on this, what looked like a wonderful trajectory of growing revenue, growing revenue from existing customers, adding new customers, and scaling profit margins uh, as they've as they've grown. And it's gone from, I think, like negative 30% operating margins to what was positive 4% this quarter last year. Now they've contracted. Non-GAAP operating margins also contracted, so it wasn't just some GAAP one-time thing. And then free cash flow dropped. And that's probably the most concerning thing of all, was not just that free cash flow margins have gone from 31% in 2024 to 25% in 2025, but their guidance for next year is 20% free cash flow margins. So I guess what's happening here, it seems to be, I wanted to point my finger and say, well, they're just They can't stop spending. It's out of control expenses. But I don't know if this is necessarily out of control expenses, or more of what they have to do as a business to improve. They are trying to move up market in their customer base, which is it's more competitive. There's other task management solutions that have carved out strong share in the enterprise market, but the customer acquisition costs are much higher. Is seems to be the case here. And then on top of that, for a long time, they benefited from product-led growth, where their customers, it'd be a small, medium-sized business that would adopt Monday.com. Either the business would grow, or they'd add more seats within an organization. And it seems like a lot of that has tapped out, and churn was apparently has I think has ticked up. They haven't. I don't think they've explicitly said that, but among the small and medium-sized business customers, churn is higher. So customer acquisition costs are rising, margins are compressing, revenue is growing, but it's growing at a slower pace. Sort of the perfect combination of terrible things to happen for a software company. Now, here's the hard part. The enterprise value to gross profit is at 2 now. And I found myself like, well, those results sucked, but hey, it's cheaper now that it's down another 20%. Anytime I start thinking like that, I usually end up in a worse position 6 months from now. So I'm wondering, I'm kind of thinking it might be time to not own this company. I was willing to look past sort of their lack of a moat early on, but now it's hard to do so.
Well, Ryan, what about, yeah, I do agree that there may be less switching costs than other software providers. That's probably the biggest concern for them, as opposed to some of those really, I don't know if I'd call it robust, but just products that people use for many, many hours a day, an Excel, an Adobe, an Autodesk type product. But I maybe would ask you, Brad, don't you have your own rule now of holding something for 3 years, letting it prove out? Maybe this is one where, and I don't know if it's non-taxable or taxable. I guess I don't have access to your own brokerage account, but if things keep going poorly, it can be the tax loss write-off for the year. You can even get back in at a cheaper price. And maybe I can also add, do you remember our journey with Wix from early 2021 through, I believe, the end of 2022, averaging down about 7 times, taking a nice tax loss harvest, and then getting back in, at the lows, honestly, and riding it to about 100% gain. This maybe is a lesson that we don't need to do that story with Monday.com, even if the outcome would be all right.
Yeah, you made it sound a little better. The
When it
tax
happens
loss
over a 2 year
harvesting.
period, it's hey, when it happens over a 2 year period, it's a lot. It's easier to say that over in 10 seconds than when you experience an 80% drawdown over a 2 year period.
Yeah, this is in my Roth, so there's no tax loss harvesting. The uh, I think you're right. I should hold myself to the anything I buy, I got to hold for 3 years. I'm probably not going to add to it. I will, unless something drastically changes. I don't see myself adding, but it is a good point and will hopefully prevent me from overreacting to a single bad quarter. Because
If they can repurchase a lot of stock and clean up that balance sheet, or not clean up the balance sheet, excuse me, clean up the, I believe they also have kind of the SBC bug. Eh, hey, falling stock price is going to benefit you over the long term. That's what you just have to say. But the problem is where people run into trouble, and I'm thinking of companies, for example, we didn't even put this on the docket. Maybe we should include this, a Hims and Hers update. When you have a company like that, risky business, maybe it hasn't proven profitability, it's in a little bit of a dynamic period. If you keep doubling down, that can be where you run into some real portfolio concerns. And you kind of, I think as you mature as an investor, I'm saying this not to you, Ryan, but everyone, I'm saying this to myself as well. We all kind of go through this. You learn that, all right, you made your bet, you maybe double down once, maybe another time if you haven't made it a large initial position. But if you thought it was cheap when you bought, you kind of let it play out. And if you have to experience a 50% drawdown, so be it.
Yeah, that's probably the way to go here. Businesses have slower quarters too. Like it's an important reminder, even in a world where like software, I think a lot of people want linear growth. It, you don't close as many deals in a certain month. All of a sudden, especially when you're moving more towards enterprise, things can take a little longer. There can be lumpiness. There can be down months, whatever. So yeah, I think that 3 year rule, I'm going to stick to it. Do we want to shift gears to any other earnings reports, or do we want to talk 100-year bonds?
Oh, I guess we can talk the alphabet. This will lead into maybe the weekly AI slash big tech update because it seems like there's something new on the docket every week with this. Alphabet did have, and this was I mean, it's a classic clickbait headline. The Motley Fool, I wouldn't say employer, the company I work for, would be all over this. You know, everyone, CNBC, Wall Street Journal, everything. They did, yes, propose to issue. I don't know if it closed a 100-year bond, but that was only a small amount for their size. It was about $1 billion. Now, the real news I would say is that here's a quote from CNBC. Alphabet is close to finalizing a global bond issuance in excess of $30 billion, according to two people familiar with the deal, an increase from the $20 billion it raised on Monday. It seems like there was, I think, $100 billion in potential demand for this debt. So there's no, and this shouldn't be surprising because Oracle was able to raise debt recently, and their balance sheet and their position within the AI infrastructure race and cloud computing is much, much more precarious than Alphabet's. So when you look at that,
It's just worse.
Alphabet, yeah, like Alphabet, it's not surprised that Alphabet's able to raise money. Now, Amazon is also looking to raise money. But what I think was most interesting is why is Alphabet raising money right now? Because Alphabet has $127 billion in short-term cash on its balance sheet or short-term marketable securities. They have $165 billion in operating cash flow. And that should really cover all of their 2026 capex needs. I think 180 to $190 billion in their guide. So what does this mean to me is they seem to think that they will likely need to overspend or outspend operating cash flow for a long time here. I think it also shows how well positioned they are to crowd out startups such as OpenAI, which is struggling to raise funding that it's been reported for at least all of 2026, I think. And it hasn't happened from what I'm aware. They Alphabet's able to raise what 30 to $50 billion whenever they want. And sorry for the motorcycle in the background if anyone can hear that. They can raise 30 to $50 billion whenever they want, and OpenAI is going to kind of have to struggle there. And what I'm kind of I don't know, this isn't a conspiracy theory, but I think this is maybe a theory I have for some of the AI build out is that for OpenAI, the longer these funders make them wait, the better deal they're going to get because they go, well, your only option. Amazon, uh, Nvidia, SoftBank. I mean, there's a few players out there, but if they keep making OpenAI wait, they can get better terms, and I think that's maybe what's happening here. And you just compare that to what Alphabet's been able to do. It pays to have that conservative balance sheet for many, many years, and now in a period where they need to get aggressive, Alphabet can kind of turn that on. And I feel like again, I know we toot their horn all the time, but compared to all the other companies in big tech, they just time even this type of stuff much, much better than the competition.
Yeah, I wouldn't be surprised if we saw a lot of other big tech companies do this as well. Uh, it sounds like Amazon already is looking for it, but Microsoft maybe too. I'm not that familiar with Microsoft's balance sheet, but you've got it's a decent time to raise interest rate wise. Like, I mean, they're getting fairly attractive rates relative to what they would have gotten a year ago. But on top of it, it's kind of, I got a feeling everyone's going to raise their capex guides even further. I think it is sort of a capex arms race at the moment, which to me, why not have the extra $30 billion in the balance sheet, especially if you can raise 100-year bonds and that long of duration? So I like the move. Makes sense. I suspect Microsoft will be following suit. The other part here is if they are making more and more venture bets, venture type bets, that kind of stuff, which we have seen, like these equity investments. It's not just their capex that you want to look at relative to their cash flow, right? There could be other forms of cash outflows. So yeah, I think it's a good move on Google's part, and I would not be surprised if other big tech companies were following suit here.
Yep. I'd say nothing else to add. You had a little thought about CapEx guidance. Anything after digesting it? We kind of did it live last week. Any other final thoughts there, Ryan?
Well, it just feels like the market's souring on the capex guidance a little bit, obviously, because the company's reported really good results, and sort of the only flaw you could point to was the capex guidance, and the stock sold off. So that kind of tells you investors have soured on some of the capex plans. But I just feel like there's a big disconnect right now between Wall Street and big tech, and like the people running these big tech companies, the people in these finance departments are not dumb. In fact, they're a lot of the brightest finance people in the world. They, I think they know why they're spending it. Now, maybe there could be demand changes that surprise them and might not hit their forecasts, but my gut tells me that if they are clamoring to spend as much as they can on compute, they know the returns they're generating. So now it is a lot of money being spent, but I do think Wall Street, it's kind of weird how they changed their mind on this. Like, it felt like they were sort of excited about it for about a year, and then big tech's like, yeah, we are too. Let's double down. Wall Street's like, well, we're not quite that excited.
Yeah, I mean, look, and again, we're not going to spend a ton of time on this because we talk about it all the time. But the problem would be Amazon is at negative cash flow, right? Or it's going to be in 2026. They're spending $200 billion in capex. And if the customers in Anthropic, OpenAI, what have you, don't show up, well, then you have overbuilt. And that's what people are starting to get concerned about. I don't know what's going
Yeah,
to happen, but this could be the time where they start overbuilding. Who knows? It also could be 2027 or 2028. No, I'm not sure.
they, unless I'm wrong here, they have a good history of uh, reaping the benefits of big capex cycles, even if it takes a little time. Like they overbuilt during COVID a bit. That's what people said. They were able to manage through that, and ultimately, they ended up filling that capacity, unless I'm mistaken. Now that was geared more towards the e-commerce business, but
Oh, yeah, that's fair. That's fair. But if they do overbuild, it will look ugly for a few years. I know there's still long-term cloud growth. Yeah, and each business is different. I mean, you could say that Google Cloud's in a much better position, but you're probably right. But here's the thing: the uncertainty, especially where these stocks trade. Well, if you have a couple of down years where revenue growth just falls off a cliff, yeah, I mean they're overvalued today. So that's probably what a lot of people are digesting.
Amazon, of all the big tech companies, seems to keep investors the most irritated. Like they tend to seem the most uncertain. It feels like whenever they start earning, they're like, "Whoa, let's pull back and start investing more. We can't show too nice of margins."
Yeah, well, their operating earnings are at record highs, but free cash flow, yes. The I think the most frustrating thing has to be the fact that there's still, let's say AI is just the total future. And first off, Alexa was supposed to be the future of AI 10 years ago. Total bust. You're still spending money on that. You're spending money on Project Kuiper. You're spending money on God knows what. And what are you like you're risking not having the funds to compete truly with Alphabet. I just think that would be frustrating. when you could have a lot more ways to self-fund.
I do own some shares of Amazon. I own shares of Google as well. I, they're not massive positions, but I'm comfortable owning them here. I think the one thing that kind of keeps me not so worried is that their core businesses are some of the widest moats on earth and should continue to grow, both for Google search, both for uh, Amazon e-commerce, AWS, Google Cloud, you name it. But let's shift gears here. I want to play a game. Is now an okay time to play
Yeah,
value
we can play
player?
value player, value trap. This is a game designed to make me look stupid in a year, but I will be willing to play. You haven't shown me the names, but I guess you have them maybe on your own little screen there.
I do.
Yeah, let's do it. Yeah, basically I just have to say value player, value trap, no explanation. Just gut check.
A little context might be nice.
Well, okay, that's fair.
Okay, I'm going to name a company, and you have to guess whether or not that company outperforms the S&P 500 over the next 5 years. These are all
Okay.
companies with low face multiples. Okay. And we can talk through some of the valuations if we want as well. But the number one here, first one for me, PayPal.
Value trap underperforms. What do you
What
think?
I'd probably agree. And this has been hotly debated for the last, I'd call it 3 or 4 years. Basically, the entire drawdown, it's felt like a value play when there seems to just be continuous deterioration under the hood. And the CEO departure, you can't you cannot overlook that stuff. Like a CEO tends to leave for a reason, and it's not just because the board thinks his performance isn't good. Like typically, I think the CEO wants out as well. It, he was there for what, 6 months?
I'm not sure. I don't follow the business that closely. Here's what I know, and I've known for a few years now: is there's no reason the legacy PayPal company needs to exist. There's no reason, or they've had an advantage with Venmo. They seem to be doing okay with it now by actually adding features that can monetize their customer base, but they totally dropped the ball on that. Even if GMV is growing, it doesn't matter if I'm sending money to my parents. It's not monetizable, and they can claim they have high volume growth with GMV on Braintree, but they're just trying to severely underprice competitors like Adyen or Stripe when they can't get process volume. Or what's that like? What's that figure? The percentage of transactions that actually close. I forget what that is, but
Approval
it's just
rate, or
not as good.
yeah,
Whatever that is. It's just they're not as good as Adyen or Stripe. So where were they going to win? And then the core business is just going to get eaten by Apple Pay and credit cards, and there's just no reason for that to exist. Cross-border transactions, you're getting eaten by Wise, Remitly, even other solutions out there. So yeah, total value trap to me. It's been a value trap. It looks cheap. I just don't see why this company needs to exist.
it's actually, yeah. So I misspoke too. The PayPal CEO was there for 2 years before stepping down. The and you see this a lot with value cheap looking companies is where it's good company, bad company, and you've got like a real cash generative company that used to be great and now it's kind of in free fall. And then you've got other good looking companies under the hood where like I'm thinking like the core PayPal checkout button, that was a great business, but now it's being eroded by competition. When you have a good company, bad company scenario, I used to like those setups, and then I realized cash flow deteriorates really quickly because the emerging companies don't replace that cash flow for a long time. So you get these persistent earnings headwinds year after year, and there's actually no certainty that a Venmo or a Braintree is ever going to replace that cash cow, and you got to invest into it. So it's I've made this mistake a number of times, but yeah, I would say PayPal for me goes in the value trap camp. Could be wrong on that. Second one here, maybe we won't spend quite as much time on this one. Adobe.
Value play. It's cheap now. I actually just looked at them today for Motley Fool, so 12 times EBIT, give or take. I think with the way the business is, even if they face a little bit of competitive risk from Figma, Canva, and some potential boogeyman in AI, there's still the potential for them to add more AI features for their customers, raise prices, and I think even if like unlike PayPal, where you say who needs this business in the modern day, you still need an Adobe type product, but you're just worried that a cloud-based solution or a point solution is going to come after them. And unlike PayPal, I think they have a much wider moat. And if that moat's attacked, they're going through a moat test right now. It hasn't shown up in the numbers yet, but for a company that's quote unquote under threat, looking to buy back stock, their financials look better. It's trading at a very similar price, and I think they can buy back a lot of shares. And PayPal might look a little cheaper, but I just like Adobe. I don't own it though, so I don't love it, but I would lean value play. And I know what you're gonna say, Ryan, because you own it, right?
Yeah, I do. And I've been just going back over some of the numbers, and if you just uh, if there was no narrative out there and you only judged a company based on financial performance, like trailing, it would have a very different multiple. But obviously, you know, you value a company for the future. I was looking since like the cloud transition. I think return on invested capital has averaged around 30 to 40% on an annual basis. The numbers look pretty good, but obviously things would change if AI started to steal their customers. Let's move on to the third one here. Lululemon.
This has been a psychological long. Yeah, you picked some good ones. I'm going to say value play, but I still haven't owned it. I honestly, I like something like Crocs more. I don't know. It's hard to articulate, but Lululemon, the management team is just off. And yes, then they're getting a shakeup here. They're gonna buy back a lot of stock, but that competitive market, it's tough. I lean value play. I think the stock could be up 3 or 4x in a couple of years, or it could be down 50% if they turn into a total just can't get that brand back.
Yeah. Yeah, I really don't know. I'm totally on the fence here. Like, anecdotally, it doesn't seem to have the same sort of consumer mind share as it used to. I think those other athleisure type brands, Aloe, etc., have certainly gained popularity with at least people I know. But
It looks like, to paint some positive for Lululemon, it seems like from what I've seen, and I'm not one shopping for this stuff all the time, that the Lululemons, Vioris of the world, or sorry, the Aloes and the Vioris of the world are more heavily discounting than Lululemon. So they're trying to just win customers, but I feel like the gross margins or the operating margins on some of these on these purchases are probably not great, and is not something. It's not sustainable. Um, Curious if you think the same.
yes, but even a discounted purchase at Viore is a purchase not going to Lululemon.
Yeah,
Like,
so what makes the industry tough?
yeah,
That's for sure.
retail. I find it so hard
Apparel.
to
They're the ones
analyze.
that
Apparel,
sell in retail outlets. Yeah, retail,
apparel.
I think, can be better.
Yeah.
Yeah.
Okay. Next one. This is sort of a two companies in one, but it's sort of a pair trade. Molson Coors and Constellation Brands, the popular beer companies in America.
I think value play. People drink beer. They're going to. Our Seahawks are having a Super Bowl parade right now. It seems to be sponsored by beer, as it always is. People are going crazy. Maybe they'll get an uplift there. No, that's not important enough. And the stocks are trading At least I can check live here on our friends at Fiscal.ai. I believe at least Molson Coors is trading at a fairly cheap price, and I would be much more given market share. It doesn't change that much. It's not as stable as cigarettes, but or soda, but market share seems to be fairly stable in beer. And even if usage is declining slightly, you should be able to outpace inflation a little bit. It says Molson Coors' EV to EBIT is -6, so they must have done a write down. Let's look at maybe cash flow, free cash flow.
No, it is
14? 14, that's not terrible. No.
it looks cheaper. Constellation Brands, I'm doing a report on them now for an episode upcoming. Yeah, tease here, value play, in my opinion. And there are some advantages. It's not quite as insulated, like you said, as like the cigarette business, where you couldn't really market products, so there wasn't as much competition. But with beers, there are production advantages to being the large scale producer. You can produce at a much lower cost if you've
And
got huge breweries.
distribution.
Yeah,
Like you go to a
distribution.
random bar, like most of the time someone's gonna go, "All right, what are you drinking?" And you go, give me a Coors Light. Give me a Corona." Right?
Give
Kind of
me,
go,
yeah,
It's something I know,
yeah.
something you know. It's comfortable. You might try something new at the store or something if something gives it to you, but yeah, familiarity I think should help these companies and make them value plays.
Yeah, and there's a big misnomer around volume growth for these businesses. Like Constellation's grown volume every year for a decade until this last year. So, it, yeah, we'll get to that in my research report. All right, let's go maybe two more here. Match Group.
Now there was just like a random tweet from a guy that that seemed to bring down the stock, which I thought was kind of funny, but I don't think it's actually affected the business. I haven't looked at their earnings closely, but it seemed to be much of the same. Tinder is still declining, Hinge is still ascendant, cash flow is okay, but consolidated figures is it's not going much of anywhere, and none of the emerging bets are working. Their international business isn't working, although it's probably benefiting from the declining US dollar. So I will say I'm gonna say value trap. I- It feels like it almost feels like the Dropbox situation we were in a couple of years ago, where you kind of go, they're buying back a lot of stock, they're levered up, the cash flow should be durable, but if there are user subscription and revenue headwinds, you want to look somewhere else. You're just gonna be, unless you have just a superb capital allocator at them, it's gonna be an uphill battle, and you'd rather own something else. I mean, for example, this is a company I just did a research report on, but you look at someone like Match Group compared to Wix, they have grown revenue pretty much every year for a decade. And there was a little bit of a bullwhip effect during the COVID pandemic, but why would you go from something that looks like a secular grower, market share taker, consistent revenue growth to something that you go, I mean, are they going to grow revenue? Okay, it's 7 times cash flow. All right, they're buying back a lot of stock, but it's just why play a hard game like that? It's kind of a picking up pennies in front of the steamroller. However, eventually, if Hinge keeps growing and they keep buying back stock, it'll work at least for a little bit.
Yeah, this is a perfect example of one of the companies I got burned on that was a good company, bad company situation where Tinder was shrinking every year in terms of users and Hinge was growing. And it's easy to point to Hinge and say, well, once Hinge is a bigger business, people are going to be underestimating what it can earn. Yeah, but for the next 5 years, cash flow is going to go nowhere because the Tinder declines are not more than offset by the Hinge increases. So that
Yeah, it's interesting, and we're finally seeing. I think this is something you don't know as just like an individual user or something, or even as an investor. We're finally seeing the full crazy dynamic of how like lopsided or the winner takes all, if I can put it that way, these marketplaces can be, which makes it very very difficult to have durable users because one side of the aisle, the men, like 80% of your users just get really upset and leave, which if those are supposed to be your paying customers, it's very, very hard to keep them around.
okay. The last two here again, sort of a pair trade, although they're not technically the same, but whatever. Gartner and Accenture.
Oh no. I don't know. I have no clue about these businesses. I don't know why Gartner needs to exist. I'm gonna go value trap. I think a maybe it's my bias because I'm not a fan of the consulting businesses. I think they waste a lot of shareholder money and just line the employees' pockets and the partners' pockets. But uh, I feel like AI is at risk of disrupting these businesses more than a lot of other software services out there because when I think of what I use AI for, it is a consultant. I was doing research for Philip Morris International, and I was thinking, oh, well, what is, I wanted to use like a little anecdote for the newsletter on emerging modes, a little marketing. Philip Morris International quarterly update will be out Friday morning. For people listening on the podcast, that will be out as you're listening to this. But I was thinking, okay, well, I want an anecdote in this story about how their market share has developed within say an emerging market. So I just asked Gemini, hey, can you tell me what Marlboro's market share has developed within India over the last few decades? And it can give me a lot of sources on that. And that's something that traditionally, like going through Google search or going through all these websites, would be difficult to find. It can do that for me quickly, and this is what, if you were a business, you would pay consultants to do. Am I wrong about that?
No, I think you're right. And there's kind of a funny anecdote this week where KPMG was apparently
Oh,
publicly
yes, I saw this,
they're
yeah.
demanding that their auditor, Grant Thornton, slash fees because AI was making their auditing work faster and cheaper. And it's kind of like people were sending the memes of like the same guy like stabbing
With a
himself in the
gun on the
back,
back of the
basically.
head,
Yeah,
yes, yeah, yeah.
because KPMG, if you think about a lot of what their some of the consultant work is, like whether it's creating slide decks, creating spreadsheets, whatever it is for the company that you're contracted with, we've seen it with Claude, I guess, with all these Claude demos where you can ask Claude's Copilot to create the deck that you want and have it done quickly. If it's way cheaper for you, if you think it's
I
cheaper at
know.
KPMG for the auditor, you are inviting your customers to ask for contract
I,
reductions as well.
from these consulting firms, I'd say start if you work there, start making contingency plans. I'm not someone that is. I'm in a job that, well, part of my job, the other job, writing, is definitely at risk of AI disruption, especially because, uh, as people are probably well known, the Molly Fool is one of the biggest SEO players out there. So like that is definitely affecting their business. There's not saying that consulting is the only business affected, but that feels like if you work at one of these companies, I would be worried. Yeah.
All right.
Sorry to, if
No,
anyone works there, I'm sorry, but that's just my honest truth. I don't want to break the bad news to you, but all right. Value play, value trap. I can't even remember what I said, but
I think you said
Lululemon
trap.
value play.
Yeah, I call
Well,
it trap.
for what ones are value plays? Adobe, Molson Coors, and Lululemon. You're gonna have your tight leggings, your beer for the tailgate, and you're gonna have your video generation, right? Or marketing. I can't even remember what Adobe does sometimes.
Yeah. And then you called Match Group, Gartner, and PayPal the value trap bucket. There were
Yeah,
some other ones on this list, but
you're gonna outsource your consulting to AI. You're going to meet the love of your life in person, and you are going to pay with Apple Pay. You know, that's the future we're living in.
I don't know about the Match Group case there, but the other ones could there could be some reality there.
All right.
Okay,
Do you want to talk Spotify and Oscar earnings, and then we can do some fun stories and maybe list some questions at the end if we have time. What one do you want to do first? Let's do Oscar since I guess you were talking a lot on that one.
sure.
People are asking about this. It's a company I've covered. I do have a free introductory research report when emerging modes was not paywalled back from the summer. I say that still would be relevant, although some of the numbers have changed. and I will be covering this company in depth throughout the next few years, or at least as long as I own it. I should say disclosure here, I haven't read the conference call yet. It came out, I think, yesterday morning. Let's go through some of the numbers. Their medical loss ratio is elevated to 95% in Q4. It's pretty ugly, but expected. Again, when you're on the Affordable Care Act marketplace, you can't reprice price plans until the following calendar year. But if your medical costs as an insurer are skyrocketing unexpectedly, as happened to all of these companies in 2025, well, your medical loss ratio is going to get worse. And this led to a $330 million operating loss, something they can manage. And hopefully it turns around in 2026. And I do expect that to turn around. But you never want that. However, on a positive note, their SG&A expense ratio keeps falling. And for any listener that doesn't know the basics of what it leads to profitability for an insurance company, you have your revenue, which is, let's say, 100% or $1 on the dollar, and that's your premiums coming in. Your medical loss ratio is going to be what you are giving out as claims each time period. And then you have your operating expenses, which is your SG&A expense ratio. So if your operating expense ratio plus your medical loss ratio is below 100%, you're generating positive earnings. Now, their SG&A ratio keeps declining, which is good because as they scale and hopefully their medical loss ratio gets better in 2026 as they reprice, that will lead to more operating leverage and operating margin expansion. So, what did they guide for 2026? $19 billion in 2026 revenue at the high end, which is much higher than I thought. I should say there's wild. It was pretty uncertain what was going to occur here. We didn't really know. I'm sure someone could have gone into a really deep dive and tried to find info and all this stuff, but I was pleasantly surprised. I thought that the fact that the subsidies were going away was going to lead to customer declines, and then they could reprice to kind of maintain revenue. But it seems like things are much better on the revenue perspective than I thought because they're growing pricing by average by about 30%. And it seems like at the same time, even though subsidies are going away, they might be expecting customer count to grow or at least be stable, which would be much better than I thought. And on that $19 billion in revenue, which as an insurer is not really that important, they are expecting $450 million in earnings from operations at the high end. Now, this is about a 2% operating margin. And if margins can keep expanding over the next few years, I mean, as an insurer, they should probably be able to get a 5% operating margin at better scale. And you add in some interest income, because remember, they have float. We likely get to I think, pretty easily $1 billion in operating and net income. And the current market is $3.6 billion. Now, are there risks? Sure. Is this guaranteed to happen? No, but that feels like a good setup to me. And I like the quarter mainly from the guide, and I think the stock remains cheap.
Yeah, I like the earnings figures there. If you're right, it seems like a lot of value here. I mean, market cap of 3.6 billion, potentially $450 million in earnings this year. What do you see? Like, this isn't an industry I'm super familiar with. How do they grow customers from here? Just be the low cost provider in their states?
They don't need to be low cost provider. I think the cost in the ACA marketplace is a little bit of a commodity. Now they are expanding to new states. They're not in every state yet. They're going to slowly expand to new states and counties. Kind of, it's not maybe just a state level. It can be a little more granular. But really, the reason they can get more customers is they just have a product that is easy to use. It's not legacy. It's not. Oh, I mean, it's just easy to deal with. They have all these tools. For example, they have for all their customers free telehealth. You can consult a doctor if you need to immediately call someone. This is included. You don't have some stupid teledoc partnership that doesn't work. You have to create an account. You don't even know how things are reimbursed. It's just easy. It makes sense. They're building out all these other things. It, it may seem like, oh, the ACA marketplace is a commodity. You have limited profitability. You have all these plans. But once you understand that the rest of these other companies just have such high levels of tech debt, Oscar seems to be in a good position, and they have proven they can keep gaining market share and they're only at a couple million customers, as the ACA marketplace keeps growing and as they move into these, as well as these, it's called ICHRA plans, which is individual contributions from your employer. So instead of the employer saying, we're paying for your health insurance, you have this plan, they give you money in a health savings account, and you basically act like you're on the ACA marketplace or something very similar. So that gives more flexibility to the individual instead of paying for this very uh, restricted plan within the employer space. You can actually pay for what you need. For example, if you need eye stuff, if you need whatever individual healthcare stuff you might need, it just makes everything better. So yeah, there's a lot of reasons, and I think you kind of look at some of these companies and you go, well, they've just kept gaining market share. This is Wix as another example. They keep getting market share. They have a decade of gaining market share. They don't have that high of market share, so why would we not expect market share gains to continue? That's about it.
Yeah, I think Wix is a great example of that. Let's talk Spotify real quick, and then I want to talk about the latest in the world of Ponzi schemes. But Spotify, old flame of ours. I don't know if you still own shares. I do not. But
I do not.
okay, numbers looked all right. So revenue grew 7% in constant currency, which isn't great, but or sorry, revenue grew 7% in reported currency. It actually grew 13% on a constant currency basis, which
Well, they
that might
report in
be
euro, right? And the euros appreciate a lot, right? So
yeah, it was quite the swing. Uh, so it's
yeah,
kind
and
of a
euro's
headwind for
gone
them, but
crazy versus the dollar. So yeah.
gross profit up 10%. They actually reported their highest gross margins ever. Uh, has there been a repricing with the labels? Do you know?
Yeah, they said on the call, actually, funny enough, read the conference call last night, and they said that with basically they expected with their latest round of price increases that revenue would outpace variable costs. So that I think implies they're able to get a little more margin out of the latest negotiations with the price increases, which is nice.
Nice.
And
Yeah, and
also,
then
ad supported margins are back to positive. They're like 20% now as they've gone to self serve. And I will say anecdotally, their self serve has improved quite a bit. Might not
what
be
do
a
you
big
mean?
business, but it's probably more probably like the what we use, like allowing podcasts or musicians to earn. It's just they built it from the ground up instead of a how should I say it? Like utilizing all these partners, they built the self-serve advertising from the ground up 2 years ago. It kind of killed their advertising business for a little bit, but now it has much better margins, and it's going to develop, I think, much more sustainable growth as they make it easy for someone like us to go, hey, you just click a button, you have two ads embedded at the 52-minute mark, and we're going to take a cut of it. You're going to take a larger cut. It's going to be just like you. They essentially finally ripped the cord off and built something equivalent to YouTube, which I think would be nice, but it's still really not that relevant to the business today.
Yeah, I was gonna say, looking back, I drastically overestimated what they were going to be able to earn in advertising revenue relative to their subscription
I
business.
know.
Uh,
Alphabet and Meta are just so much better.
yeah,
That's where the dollars go.
yeah.
It's the truth.
The operating income grew 47% year over year. They actually, we've seen just pure operating margin expansion over the last 2 years. And then subscribers growing 10%, monthly active users in total up 11%. This is a fine quarter, but I'm just not drawn to this business at the current prices. It seems expensive for me, and this I feel like people are under. Maybe I'm wrong here, but I think Spotify is more of a mature business than people give credit for. I mean, 700 million monthly active users. I don't think they're going to be reaching Facebook level usage. So
That's
maybe
fair.
maybe there's more pricing power than I'm thinking, but
Yeah, I mean, look, they execute on the audiobooks and they execute on maybe some more podcast stuff. They maybe will be able to raise prices even more, make it a bundle. They've talked about the super tier. I don't know if that's worked with the labels because they kept delaying that. Maybe negotiations are going poorly with that. But hey, on the conference call, Ryan, they said we're at 3% of the globe. Something, I think 3% of the globe is a paying subscriber. And they go, why not 10%? That's kind of what they said. That's fair if you price it correctly. I don't know if 100% of the internet using world is going to be paying for a music streaming service. But even if it's 50% or 40%, and you say within that, there's going to be Spotify, YouTube Music, Apple Music, and maybe a couple of others in international markets, could they get to 10% of the global population? Sure. Sure. That feels like a bit of a reach, but there's probably still room to grow, I'd say. They got to execute, though, because YouTube is, they're smart, they discount, they bundle, and they're going to have to execute. That's for sure.
Yeah, I mean, like, let's say it does go well, they execute, they triple their users, which would be pretty incredible. It's at a price to sales today of like 6. I think the likelihood that you see material margin expansion from here, like, they're, I find it pretty unlikely that they're going to double operating margins over the next 5 to 10 years. It seems like that would be
Yeah.
pretty hard to do. I
Yeah,
just,
it's not a great price, especially when it's not a wide moat business. I'd maybe, given my framework, consider it emerging moat potentially, but it's not. There is execution risk. I love their management team. I think it's fantastic, but the stock's not dirt cheap.
all right, let's talk Ponzi schemes. What is your bubble watch for this one?
As people who spend time on Twitter, have you heard of this guy, Ty Lopez? He's big on Twitter/X. You've seen this? You've seen this guy? I have not.
Like 5 to 10 years ago, he used to run a ton of these like YouTube ads for like, I'm gonna teach you how to get rich in 5 days, and it's like it would just be him like walking around his mansion. He was like he was one of the like first, maybe not the first, but felt like one of the big YouTube like get rich quick influencers out there. It
All right.
seemed like a
Well,
terrible guy, by the way. Sorry, I'll say it now. Spoiler alert. He seemed like a scam artist from the beginning.
yeah, and unfortunately, he scammed a lot of people. Okay, here's the headline from the Wall Street Journal. He vowed to revive Radio Shack and Pier 1 imports. Investors say they were swindles. His name is Ty Lopez. Here's a quote. The college dropout had made a name for himself on social media by offering get rich quick advice and self help courses, as Ryan mentioned. He urged his followers to invest in a new company he had started that was scooping up distressed retailers on the cheap: Radio Shack, Pier 1 Imports, Dress Barn, Sporting Goods, Linen and Things, with a promise to turn them into e commerce winners. I gotta say, even if this wasn't a scam, why
What
are
a
you investing in this?
Yeah, what a hard turnaround.
He used a lot of social media marketing. Lopez was able to convince investors to give him a total of $230 million. I will say some people are just good at raising money. You got to give props to the guy. That is difficult to do. Some people are good at raising money. Now, don't be a scam artist. Golden age of fraud. Let's not do that. Be a legitimate person. But man, that's a good skill.
Yeah, not only did he raise $230 million, he raised it for a bad idea. That really is quite the promotional activity.
Yeah, here's another quote. On his podcast, The Ty Lopez Show, and in his social media post, Lopez, who is 48, hasn't addressed the company's collapse and the heavy losses incurred by his investors. The day after the SEC filed his suit, Lopez posted on X, never doomed, no matter how horrible the situation. Don't ever think you're doomed unless you are dead. All defeat is psychological. When he's in the Southern District of New York prison, I wonder he's going to be thinking then. Now, it was really a sad story because the marketing materials they provided investors with lacking any detailed financial information. That's red flag number one. And they promised a 20% return. That is red flag number two. That is classic scam artist behavior, is promising a specific return number, because that's how, with their Ponzi scheme, they say, all right, well, this is what I need to allocate. And then this is what I need to bring in to pay out these existing investors. There's some very sad quotes from the article. Here's a quote. Some of Lopez's investors said in interviews that they believed in the brands he was buying in his message and was reassured by the monthly payments they were collecting. Nelson Rowe of New Iberia, Louisiana, an 82-year-old retired real estate broker who invested $300,000, said Lopez seemed credible. The story sounded so good. They had all these brands. Well, that's tough. And then there was another screenshot here, which was from an investor. And for anyone that's, I know we made a lot of dating references this episode. Anyone that's dated in the modern world, and now these old dudes might not be dating these days. You should have known it was over when you seen these text messages, because if you see the screenshot here, his investor said on December 27th, "Why can't you respond to my question? Not cool." Lopez said, "Hey, this week later we'll have more updates." The guy responded, "Okay, but is my $500,000 safe?" Lopez didn't respond. Then on February 6th, the guy sends him a question mark. No response. February 8th, double question mark. And then I think a couple days later, exclamation point, question mark. Look, this is like when the woman says after the third date, "Had a great time," and then you follow up the next day later or something. "Hey, I'd like to see you again." And then if you don't get a response for a day, you just know, like in this situation, things are not going well for you.
Yeah, it feels like this seems like a guy who has taken advantage of a lot of people for like 10 years. He's kind of built a business off of it. Uh, but maybe this will be hopefully the cautionary tale that gets published for people to stop falling for these kind of things. The other one, the thing
No,
I
Ryan,
find
Ryan,
funny,
it's the golden age of fraud. This happens all the time. This
it
happens
does.
all the time.
It does,
It
yeah.
happens daily. Chow ZZ was just talking with Chamath on a viral podcast.
It my I think my favorite thing is when something like this is going on and people just go about the whoever the scam artist is just goes about their day like it's not happening. Like this guy, the Ty Lopez show, he recorded his latest episode and just had had nothing to do with the allegations. So
Well, here's the funniest thing. This is what they said. The last episode was on January 13th, and it was about why 90% of businesses fail. Ironic?
poetic
Is he trying to tell us something?
justice. Yeah. Uh,
All right.
let's take some listener questions
Anything
here.
else?
Rapid fire. SoFi, are you buying the dip?
Let's check the price. I haven't checked. I kind of know the business roughly, so we can look at what the share price is trading at. And I will say these questions come. I usually do one of these plus some other conversations within the Substack chat. It's called the Emerging Mode Substack, but if you subscribe for free, you can just join the chat room on Substack. It's pretty fun. We have a lot of fun conversations and people tossing out a lot of ideas. Actually, one CLBPT that I wanted to talk about this episode, but we'll save for a small cap of the week in the future. SoFi is at $20 a share. It's down a bit. I'd say I'm interested, but not definitely not buying. I don't know why it's falling, and it's trading at 2.6 times book value. ROE is very, very good. Well, I think it will be very, very good, and it's going to show up very, very strongly. But yeah, I'd say a little lower. I'd be interested in buying.
Yeah, I like SoFi. I like Anthony Noto as well. It seems like kind of the best run neobank out there at the moment. The last time I visited it, I remember having some questions about them sort of getting into a new lending category. I believe like just not having that much time under their belt in personal lending, which is like the bulk of their new volume. So
Right.
there could
Give a
potentially
little
be some
discount to
stuff.
the lack of trust with management. Yeah.
Yeah, but as far as like a consumer app goes, I think it's exceptionally well run. How about this one, Lyft? This I have heard is actually potentially a value play. I think they're buying back like
I got
10% of their
one word
shares.
for you, Whammo.
Why would do you think Waymo is going to kill Uber?
I think Uber has a better ecosystem.
I
You kind of get what I mean?
uh, if Waymo won't kill, I think Lyft could have problems for other reasons, but I don't think Waymo is going to kill Uber. And if it doesn't kill Uber, I don't think Waymo would kill Lyft.
Maybe that's a longer discussion to have. I'd be a little more concerned, but yeah, the stock looks cheap. That's for sure. All right, we have another one. Team Atlassian. Basically they said team is better down more than the rest of software. Anecdotally, look, let me. The Motley Fool uses Atlassian software. Do I get frustrated that I have to learn about it all the time? Sure, but there's a lot of switching costs with that. And EV to free cash flow right now, probably about SBC is 17. EV to gross profit is 4.7. Pretty cheap. Yeah. They buy back a lot of stock. Yeah, things could work.
They are the biggest abusers of stock-based compensation of like the big software stocks out there. It theirs is insane. Like there's a lot of companies that issue stock-based compensation and use it as a tool for talent retention. I don't know if I've seen anyone at the scale of Atlassian have issue so much in stock. And then I saw they came out this quarter and were like, our stock's way too cheap. Get ready for us to get aggressive on the buyback, basically. And I think they're still net diluters. And they've bought back. They've spent a lot of their cash flow on buybacks. Let me double check and make sure.
Yeah.
I'm checking shares
Oh, I
outstanding
mean,
right now.
it's rough. It's rough.
Total shares outstanding quarterly. Uh, 1 second.
I
Grew.
I can race and get it. It grew. Yeah. Well,
Yeah, it has grown.
I think they banned. Didn't they say they banned executives from selling shares? Something like that. We're halting it. Oh yeah, well your stock's cheap. I guess let's just stop. Look, this is a good follow up someone had on the Constellation software episode too, where you have people, even Constellation, they're not diluting, but you have people say, take your bonus and buy stock. Well, if someone bought 50% higher, or God forbid, 80% higher, and then your stock goes down, they're gonna say, look, you want me around? I need a lot more stock. So it can get really tough when you get on that SPC treadmill.
Yeah.
But I think it probably works from here.
All right. I think that's going to do it. Thank you, everyone, for tuning into this episode. We want to remind listeners that Brett and I are not financial advisors. Anything we say or discuss here on this podcast is not formal advice or recommendation. We may buy, sell, or hold any of the securities discussed in this podcast. Once again, thank you for tuning in, and we will see you next time.